All right, so we've already discussed break-even uh, analysis in terms of determining what we have to sell in terms of units or what we have to sell in terms of total dollars to break even. But the thing is, our goal when we go into business is really not to break even. And given the nature of the business and assuming that we have some idea in terms of what is realistic, what we can do is we can use cost volume profit analysis, and really the basic formula for break even analysis, to calculate the number of units that we need to sell and the total revenue that we have to have for to achieve a certain level of income. So if we look at this slide here, we have a situation where the company, I forget the name of the company, they want to earn a profit of $100,000. And using the contribution margin approach, all we really have to do is take the exact same formula that we had before, which was fixed expenses over unit contribution margin, and then up here in the numerator, we're just going to add our target profit. So before we had 80,000 over 200 to give us 400 surfboards. Now, if we add 100,000 to the mix, this is essentially 180,000 over 200, and we can determine that to make $100,000, we will need to sell 900 surfboards. Again, given the same information as before, $500 sales price per surfboard, $300 variable cost, no change in fixed cost of $80,000. The equation approach is the exact same as what we looked at before, except for now, when we solve for X, our end result, instead of being 0 here, is 100,000. So it's the exact same equation as before, but we're replacing the 0 with 100,000. Solving for X, we will come up with the exact same 900 surfboards as required before. Again, I do prefer the contribution margin approach, but most of what we do in accounting is extremely basic algebra, and so the equation approach may be better for you. All right, so we have established a couple of pieces of information so far with regard to the surfboard company. The first thing is we know that we have to sell 400 surfboards to break even. And the second thing that we know is if we want to make $100,000, we have to sell 900 surfboards. So now we're going to introduce this concept called safety margin. And we can use safety margin in terms of units, safety margin in terms of dollars. And it says here the difference between budgeted sales revenue and break-even sales revenue is the safety margin. And that is the amount by which sales can drop before losses begin to be incurred. So if we budget for 900 units based on that target income of $100,000, well, that doesn't mean that we're going to sell 900 units. Now, if we sell more than 900 units, that's great. But let's say that we fail to sell 900 units. Now, if we sell 875 or something like that, that's not a big deal. But let's just say that we seriously misjudged the market for these surfboards. We might be curious to know how many units we can afford to drop before we start losing money. Now you may be saying, well, wait a minute, that's pretty simple. We already established that break even was 400, so at 399 we're going to lose money. Well, that's true. That's absolutely true. But I want you to understand that for purposes of this particular class, for this class only, we are not going to look at any kind of multi-product analysis. Okay, we're looking at one product in here. But I think you can probably figure out that if we were looking at multiple products, this idea of safety margin would become far more beneficial and useful to us. So here we have an example with safety margin. It says since Curl, that's the name of the company, Curl has a break-even point of 200,000. Now it looks like they're changing it here. It says if estimated sales are $250,000, the safety margin is $50,000 in dollars and 100 surfboards. Okay, so here we have a much smaller gap between the break-even and the estimated sales units, and so safety margin is a little bit more important. We don't have nearly as much room for mistakes. All right. One other thing that we need to consider is changes in fixed costs. We'll also need to consider changes in variable costs. But it says Curl is currently selling 500 surfboards per year. The owner believes that an increase of $10,000 in the annual advertising budget would increase sales to 540 units. Should the company increase the advertising budget? Okay, and this is kind of a tricky concept. We're going to have enough of a spread here that I think you'll agree with the answer. But let's look here. If we were to sell an additional 40 units at $500, we would increase our sales revenue from $250,000 to $270,000. Well, that's good. But remember, each one of these 40 extra units is going to incur that same $300 variable cost. So if we were to multiply, bear with me one second, if we were to multiply 40 times 300, that's an extra $12,000 in cost. And there it is right there. We go from 150 to 162. So our contribution margin went from 100,000 to 108,000. That's a good thing. But look what happened to our expenses, our fixed expenses specifically. We went from 80,000 in fixed expenses, which is the number we've been dealing with all along, to now 90,000 in fixed expenses because we increased the advertising budget. Our net income went down from 20,000 to 18,000. Okay, so if we're going to look at this strictly based on the numbers, we're actually better off selling 500 surfboards than 540. Again, assuming that that we have to spend the $10,000 extra to generate these 40 extra sales. Now, I do want to say one thing. In this particular case, our net income went down by 10%, and 10% is nothing to ignore. That's a pretty big drop. But I would say this. Let's say that we anticipated a minimum increase of 40 units by spending that $10,000. We might consider going ahead and doing this and sacrificing some profits, because what have we done here? If we were to take 40, which is the number of increase in boards, and divide that by our original sales, that's 8%. We've increased our sales by 8% in terms of units. Those 40 boards are surfboards that our competitors are never going to sell because we sold them. And if we end up putting our competitors out of business ultimately because we're willing to take a little bit less profit, ultimately we might capture the entire market or a much, much larger portion, and we don't have to advertise as much. So I just want you to understand, the math says to not do the advertising. That's probably the right decision, but there are some qualitative aspects that we want to consider other than just the quantitative final net income figure. So here we have, this is the guy where I'm assuming who had the idea to increase the advertising budget, and he's all sad because even though sales went up, everybody's happy except for the shareholders because they have less money now. Okay. All right. We can also have the exact same situation happen with our variable cost. It says because of increases in cost of raw materials, variable cost per unit has increased from $300 to $310 with no change in selling price per unit. What will be the new break-even point? Well, our equation is the exact same as it was before with one small difference. This number for our variable cost changes from 300 to 310. So our per unit contribution margin is no longer $200. Now it's $190. Okay. So if we were to use the, let's see, what was it now? We had $80,000 in fixed cost divided by a unit contribution margin of $190. Well, I did something wrong there. Divided by 190 equals 21.05. What am I doing wrong here? 80,000 divided by 190. Ah, there it is. Okay, very good. I just couldn't see the number. We have a break-even point of 421.052, which technically does round up to 422 units. At 422 units, we're making a very, very small profit. Okay, sorry about that technical glitch. And then we also can look at items such as what if we increase the price of the sailboards, or surfboards rather. We go from 500 to 550. Variable costs are the same at $300. Let's see if the math comes out on this. So our contribution margin is going to be $250 per unit. Divide that into fixed cost, 320 units. Math's a little bit cleaner this time. Okay. And then we can also predict profit given a expected volume. So here what they've done is they have budgeted for the sale of 520 surfboards with an expected contribution margin per unit of 190. All we do here, oh, and this also says fixed costs are expected to increase to 90,000. So lots of bad news here. Our variable costs have gone up and our fixed costs have gone up. We take the 190 contribution margin per unit, multiply it by the 525 sales units, and subtract out the fixed cost. This equation gives us 99,750 minus our fixed cost, and we can say, okay, given this level of activity, we have $9,750 profit. So maybe we want to figure out ways to reduce our variable cost, increase our sales price, or maybe reduce some of our fixed costs that are unnecessary. Okay, we've got some information here on a traditional income statement. I want to point out one thing. This $380,000 here, it's not labeled, but this should be something like cost of goods sold. And then we have our income statement and a contribution margin format, and you can see we've broken down all of our variable expenses and our fixed expenses. Either way, we come up with the same $50,000 in net income. All right, so that's it for this chapter. And I believe for this class, that is the last chapter. So get your homework done, study the videos. Good luck.